Hey traders, Raghee here. Happy Monday, everybody. Welcome to a new episode of Charts and Coffee. We're going to take a look at the markets and take a look at what we've got coming up this week. Probably the first pressing issue for a lot of the bulls, a lot of the buyers out there is, will we continue to see movement higher? And for me, it's not a matter of looking at the markets broadly in terms of movement higher. Let's keep in mind that the NASDAQ is not in an uptrend. Let's also keep in mind that the Russell is not in an uptrend, but we do have very good uptrends. We have for some time. These have been pullback buys that we've been focusing on for, at this point now, over a month, a couple months actually, in the Dow. And then the Dow is going to allow the S&P to not necessarily break away from its tech weighting, but it's going to allow the S&P to at least buck the trend a little bit of its tech weighting and track with the Dow. So you remember that the S&P is vulnerable to NASDAQ choppiness, but it can also be benefited from the best place in the market to look right now, which quite frankly, if you're looking for a trio of market to look at rather than Dow, S&P, NAS, why not look at Dow, industrials, and transports? And these continue to be the places that we've been focused on since, quite frankly, March. And these continue to move higher with the clearest bullish structure. Now, why am I focused on bullish structure? Why, when I'm going through the markets and we're comparing a market that's in chop to a market that's in a trend, do I consider those as different as chalk and cheese? The reason that they're so different is the way that we would trade a trending market and the probability of success, the probability of certain levels holding are going to be higher in uptrends. For the most part, almost everybody in these rooms right now, almost everybody, there's always going to be an exception, but almost everybody is going to find that their trading, their account balance, and their overall success, their win rate is going to be higher in an uptrend, in trending markets. So why not prioritize that type of market behavior that is best suited for the widest variety of traders, whether they be trend traders or whether they be momentum traders. So keep in mind the environment that is best for your trading, and you'll find that your trading is going to just be better. That means what we trade is more important than how we trade it. That means 80% of your time, if we're going to use Pareto principle, 80-20 rule says what? 80% of your results come from 20% of the things you do. Well, I'm sorry, 20%. So what would be the best place to spend our time? Watch list building. I think most traders believe that larger, more inordinate weighting spent on strategies and analysis on a particular set of symbols that are usually sort of whatever's in the headline or whatever's just sort of commonly traded is going to lead to success. When in reality, if you spend most of your time on watch list building, you will find that the trades almost tell you, they almost happen much more organically. You're not having to force anything. So that's what we want to remember. And then, let's also keep in mind, we need to spend some time on the economic calendar, whether that be the earnings calendar, which is actually quite busy this week, and whether that be the different events. We have a slew of central bank speak. Now, today's central bank speak is important to me for two reasons. I'm long the Dow, I'm long Germany, and I want to get long the UK. So we've been long Germany for some time via EWG. I want to get long the UK market, the FTSE via EWU. We're already long the Dow, industrials, home builders, construction, financials, healthcare. So yeah, when I've got a morning where I've got Clarida, my gosh, not once, but twice. I didn't think he had that much to say that was frankly that interesting, but there you have it. So does Empire Manufacturing Index mean anything when I've got Clarida squared, Bostic, and then I've got a bunch of MPC members? That's going to impact my pound trades, and my UK trades. So lots to look at today, depending on where your focus is at. All right, so let's take some questions here. Quick roundup of where my attention is, and let's jump on over to the charts. All right, so first up, love the question. Hey there, Stephen. What are my thoughts on corn? Sure. So when we take a look at corn and we look at the overall trend and the pullback that we've seen, this is a long in corn off the wave. We are looking to get long corn. We want to stick with long grains, whether that be corn, whether that be beans or bean oil. That's the third grain. That one's part of the soybean complex. I'm not really interested in meal. Remember, when you start wandering over into things like wheat and oats, they become relatively illiquid, when you're comparing that to corn or beans. So I like the long in these markets, and pullback buys in a double green environment. Absolutely. I'm with you. I like the long position on the pullback, but not really until then. The first opportunity to buy the pullback was the aggressive 21, but the reversion to the support, the mean, as far as I'm concerned, is the 34 EMA wave. And 21 is great. 13 is okay too in a parabolic market, which is why I would pay attention to 21. But here we are pretty much bouncing off the wave perfectly. So keep that wave in mind. I think a lot of times people ignore the 34 EMA trio of high, close, low in lieu of, say, the 21, but the 21 is going to be pretty aggressive. And if the market pulls back even further, you'll find it will sometimes even exceed the wave and hit the 55, but I'll look at the wave as that sweet spot. All right, so can I explain what the wave is? Sure. It's the 34 exponential moving average on the high, the close, and the low. It's 334 period exponential moving averages that move, well, like a wave. So that's why I call it the wave, not to be confused with any other kinds of waves, whether it be Elliott or whatnot. But no, this is just three moving averages, and that's what the wave is. Please do a tour of my bookshelf. Yeah, maybe sometime, right? Yeah, maybe sometime. Thanks. Yeah, you guys can see you can see the bookshelf there behind me. I love books, love, and there's another bookshelf right to my left. So I might need an intervention. It's probably getting to that point. All right, next up. Hey there, Jonathan. Good morning. Last week I mentioned validity as a measure of whether to stay in or get out. Sure, point of validity. That's kind of a phrase that I coined early on in my career to keep me from arguing and messing around with stop losses. I've also heard a 20% option premium, 25 actually. Confused. First parachute that opens. Oh, so what am I looking for? Sure, there's a validity to the trade. There's a validity to a trend. There's a validity to distribution chop. There's a point on the chart represented by price where a trade is no longer valid. But that doesn't mean it's affordable. So what do I mean by that? And that would take us into a much deeper conversation, Jonathan. But what that basically means is that we have to separate where the validity of the trade is from whether I can afford to sit through the trough, for example, down to that validity before I exceed what's affordable in terms of the budget that I've allocated to the trade. So yes, those are probably words and concepts that are kind of foreign to a lot of options traders. But I think it's why, whether it's a new trader or myself, we can keep from risk of ruin. I'm one of those traders that doesn't believe that a rite of passage as a trader is blowing up your account. I don't believe that at all. I've never blown up an account. And I don't say that to brag. I say that because I was taught by my mentors very early on what it means to understand your proximity to risk of ruin and how risk of ruin, which is 50% of your account, dictates how large you can trade and how much you can risk. It's simple arithmetic. But blowing up an account is always breaking the rules of that simple arithmetic. So yes, there might be trades that haven't reached validity, but I'm going to have to say, because of where I got in, it's no longer affordable. And if you enter enough positions that can get you towards risk of ruin, for example, if many of them or all of them were to get stopped out, that's where your account size determines trade size and the number of positions that you can have on. And if there is a holy grail to trading, it's not an indicator, believe me. It's not a strategy. It's not intraday versus end of day. It's position sizing. That's the holy grail. But it's, let's face it, it's the most unsexy thing ever. People say, well, what's the holy grail to trading? Understanding your position sizing in relation to your exposure to a sector, exposure to a trend, exposure to, any number of factors, and then what each trade would represent if it were to hit its stop. So it's a huge conversation, Jonathan, but I hope that gets you down the right path. All right, next up is AA and VALE. All right, so take a look at, there we go. Gorgeous uptrend. What's not to like about this? Excuse me. What's not to like about this? Is this a parabolic market? It's one thing we need to ask. Because if this market has accelerated, gone parabolic, and I use historical volatility to determine that, if this is a market that's gone parabolic, then yes, then the space between the 13 and the 21 exponential is a valid zone, aggressive, but valid for a long. If not, I'm going to wait for my mean. I'm going to wait for the reversion to that retracement, that pullback to the wave. But that's long, 100%. Same thing with VALE, straight up long. Is it a parabolic market? Yes, I will initially look for some support between the 13 and the 21 exponential moving averages. And then if that gets exceeded, I'll consider the wave. The wave is an interesting zone, though, for this trade because the wave is sandwiching the $20 mark, that psychological level. And 20 is far more psychological than, say, 30 or 40. Because 20, interestingly enough, is this sort of line in the sand that a lot of traders, 10 and 20 actually, 10 and 20, that a lot of traders and frankly institutions won't necessarily put a heavy focus on stocks below $10. And oftentimes that's going to be a little bit not as strictly adhered to, but under 20 is going to fall into a separate category as well. So in terms of staying in this zone, it would probably be pretty important for from the parabolic standpoint, but the wave and that $20 level could be interesting for a pullback. So yeah, I think that VALE is an interesting name to watch for sure. Next question is lumber to gold ratio. Line watcher, I'm right now lumber to gold or anything that has to do with lumber. And no, I've not in 30 years, I've not heard any consistent conversation about lumber and gold. But remember, lumber is sort of the popular kid in class right now. I look at the gold to copper. Gold to copper is far more, I think, mainstream discussed. I think everyone's going to look at lumber as something. So no, I've not consistently heard about anything like that. But, depending on what's happening at the time, different correlations are going to pop up and different conversations around correlations are going to pop up. So it doesn't surprise me. But no, that's not something I have found is a consistent conversation in the market. That's not to say there may not be something to it. But remember, lumber is very much kind of the poster child right now for the reflation environment that we're in. So if that's sort of the replacement for copper, which is what I would kind of presume it is, because copper is much more of a reflation metal, the way lumber would be also a reflation commodity. So I think it's probably a variation, a spin on that very much more well-known gold-copper ratio. All right, is there an option or option or ETF to trade the euro? Yes. If you're looking at options, you can look at the futures options. You can also look at the ETF options and the FXE. This is a currency that we're long in right now. We got long Europe and we got long the euro. Why long the euro? It's a dollar short. If you're looking at currencies, and thank you for the currency question, by the way, Randy. So if you're looking at currencies, and what I'm about to say might seem a little odd because so many people spend a disproportionate time talking about DXY or even UUP or dollar index, you will seldom find me do that because it's actually kind of a blanket it's a funny version of the dollar. It's not really a useful version of the dollar. It's not a currency trader's view of the dollar. If you want to know what the dollar is doing, you have to separate its relationship between all types of currencies. You can lump in yen and Swiss franc together. The euro is the most inversely or negatively correlated currency to the dollar, which means if the dollar goes up, the euro goes down and vice versa. Then you've got your COMDOLs, Australian, Canadian, New Zealand dollar, and you got your pound, which sort of stands out there on its own. So when you're looking at the dollar, your best bet to play dollar weakness is not to short the basket. It's not to look at the DXY or the UUP. You will seldom see me do that because it's utterly useless. What you want to focus on if you're playing the dollar is exactly what you asked me. So kudos. You want to look at what the euro is doing. If you want to look at the dollar's place in terms of reflation environment, and you want to short dollars or buy dollars against COMDOLs, that's Australian dollar versus US dollar, US dollar versus Canadian dollar, and New Zealand dollar versus US dollar. So I love the question. Yes, just know what you're trading when you're trading the euro. And by getting long the euro, what I've focused on is really, am I that optimistic about the euro? No, it's just the easiest, cleanest way. Amongst really three of them that I'm looking at. Pound is back in contention too, so 4. So short dollar against euro, pound, Canadian dollar, which we already have an open position on, and Australian dollar, which I'm putting on the back burner for now. So lots of interesting ways to short dollar in this macro economic cycle that we're in. All right, thank you for that question. I love when currencies come up because I think currencies are the biggest market in the world, but to be a trader in the States, you would never know it. Because currencies end up such a distant third to just about everything, stocks, treasuries, maybe even commodities, then currencies. And yet currencies and countries will give you such wonderful liquid opportunities. So thank you for the question on currencies. And by the way, FXC, Canadian dollar, and EWC, just straight up playing Canada, have been en fuego. These have been fantastic trends that are even better than the Dow, certainly better than the NASDAQ and the Russell, and better than the S&P too. So again, find those trends. Think out of the box if you have to, right? Don't go where everybody else is going, which is what's happening next with Netflix, what's happening next with Facebook or Google or Amazon or Apple, or forget tech. And I know that sounds kind of, oh gosh, but tech had such a great day. It had one good day. It's not trending, right? If you're looking for higher probability markets and you're focused on tech, you've been missing pullbacks in the Dow. You've been missing pullbacks in industrials and in financials. And that's where we all have attention that's finite. If we had attention that was infinite and we had capital that was infinite, fantastic. Then we can play all these things like some of the more minor plays in NAS. I say minor because they're not trending. So, it's the same thing that we talked about, I guess, last Wednesday when, I mentioned that, sure, we can now get into a distribution fade in the Russell, but please play the KRE instead. Path of least resistance. Where is the best structure? Focus on those markets. Let your watch list building be 80% of what you do. Humor me for a week. Humor me just for a week. You'll find your trading is far, far better because you're focusing on the best markets, not deploying a certain asset or indicator in the best way. Now you do both of those together, boom. Now you're putting the best, now you're putting the best of both forward. All right. Having said that, now it's time for me to jump on over into the options room. I'll be doing the open there in just a few seconds. So great to see everybody. Thank you as always for joining me for Charts and Coffee. And I'm going to give it to you real. It may not be always the most popular thing to say, but I will talk my book. I will tell you what I've got skin in the game in. And I've got a lot of other markets that have been outperforming some of the sort of regular popular markets to focus on. Don't get trapped into doing that. Don't get trapped into doing that. There's a lot of good moves in this market right now. You just have to know which corner of the market to look. Be good to each other. I'll see you tomorrow.